Hello, hello.
Hey, how you doing, partner?
Can you hear me, Larry?
Yes, sir. You're coming in perfect. Coming in perfect.
Come on, really? I hate,
You're absolutely coming in perfect.
listening to shows where I can't hear people because I just about lost my hearing. So I want people to be able to hear me. So you think I'm okay?
You're coming in just absolutely perfectly, my friend. Yep, just absolutely perfectly.
You know, you got a velvet voice. I haven't heard you on radio before. You know, you sound like a real pro.
Oh yeah, that's me. Me and Johnny Carson. Yeah, look, you're gonna get your big check, so don't worry about that. Folks,
right.
I met Joe back in 1970 when we first moved to the Conti Commodity Building. You're an engineer, aren't you? Weren't you an engineer, Joe?
Yeah, electrical engineering, and that was real helpful to me to understand what was going on in the market.
Yeah. Wow. Well, listen, we got plenty of time here, so we've got this chart up here about market structure. Do you want to start with that one?
Let me see if I can find it on my own computer. You know, we're all victims of technology. So anyway, I'm looking at the market structure. Look, what I want to talk about today is not how terrific my trading system is or how much money I make or anything like that. I don't care. What I want to talk about is what people are actually up against when they trade in today's markets. And there's been a sea change. Markets were essentially similar from the 1800s until March of 2009. And when March of 2009 occurred, we had a change in market structure. And what I'm talking about is that Skynet took over. We have computer algorithms that are now controlling the markets. And markets, it really is different this time. People better listen and people better watch out, because what they were up against in the 1800s, 1900s, and up to March of 2009 is not what they're up against today. Things have changed. So this first chart is showing you how it used to be. And it's showing a pyramid, and it's showing a building. And the building of this pyramid has to do with time frames in the markets. Can I go on, Larry?
Yeah, you've got the whole time, and you've got my interest, and that's not easy to do. so go right ahead.
If I got your interest, I'm happy, because when we talked, what was it, a week ago? First time we talked in 15 years. I said I wanted to mention this to you, but I said let's save it for the radio show, because let's keep it fresh. Maybe you agree, maybe you don't agree, but bottom line here is that if you've got plumbers and auto mechanics and you've got construction people out there, they're going to understand this. But if you've got people out there only working with their heads, they don't understand structure, then they're going to have a little bit of a problem. But what happens here is that you've got different time frames. Now, the time frames I've got pictured on this pyramid are time frames which the computer algos depend on. And there's a couple I don't have on here. But basically what's happening is that if you're a 1 minute trader, you're depending upon the liquidity that happens in the second time frame. If you're a 5 minute trader, you're depending upon the liquidity that's occurring on the 1 minute time frame. If you're a 20 minute trader, you're dependent upon the 5 minute time frame. 30 minute trader on the 20 minute time frame. So what you're doing is, as you go up this pyramid, the weekly players are depending upon the daily players. If there's no liquidity in the daily players, the weekly players are SOL. You know what that means?
Yes, sir.
Same thing with monthly players. All right, so this is the way the market used to work, and of course there were dislocations. There was high volatility. You had situations like August of 1987 where things fell apart. But today, let's go to the second chart. You're going to see a pyramid doesn't look like a pyramid anymore. You're going to see a pyramid that sort of looks like a diamond. And what's happening here is that the computers, the algos, have literally destroyed the lower time frame traders. I mean, they ain't there. So you have very few traders down in the 1 minute world and now in the 5 minute world. So therefore, the people that are in the 20 minute world and the 30 minute world, they cannot depend upon the liquidity that used to be there from the 1800s until March of 2009.
And Joe and I have been friends for 49 or 50 years, and we have a couple of notices here. Joe, one is from our fearless leader, Tom O'Brien Sr., said to say hello to you. He's an old friend of yours, and there's been 2 or 3 other people here in the den that have worked with you, and they speak very highly of you here in the den. So you've got a great reputation. So, hey, Joe, I'm just going back memory lane for just a second. Do you remember Jay Cross? Remember how he used to talk about displaced moving averages, and you were using those for some time. Did you ever use those anymore, Joe?
Well, I'm going to tell you a secret since we're walking down memory lane here. First of all, Tommy, he's the best. I mean, I still remember having dinner at his house, 40 years, 30 years, 20 years ago, patting his big German shepherds and eating some delicious steak. He's a great guy. So, I wish him the best. And, the 2 of you, how long have we been together? Jay Croft, Jay Croft, and there was one other individual, you were actually my mentors. Now, by being a mentor doesn't mean that you sat with me for, 3 years and taught me how to trade. What that means is that no, really. What that means is you flash the flashlight in the right direction. Jay did, you did. I still remember I went up there and saw you in someplace in California, and you actually introduced me to the very basics of expansion analysis and retracement analysis, from which I developed an entire trading system. Jay taught me about displaced moving averages. I didn't spend more than 10 minutes with Jay. Yeah. But to answer your question, yes, I still use them. And if somebody throws up a 25 by 5, it's 25-day simple moving average at the close, displays forward 5 days, they're going to find out that this thing really held the S&P futures markets. It's just amazing. And the 3 by 3 is the basis. The 3-day simple moving average displays forward 3 days is the basis for a lot of my patterns that are in my book, in Chapter 6 of my book, Trading with DiNapoli Levels. So the answer to your question, yes. And to this day, I am grateful to both him and of course to you for shining that light in the right direction. There was a third person who, again, I spent about 2 or 3 hours with him, but you guys were the 3 people that got me started in the right direction. Before that, I was in a closet and I was banging around trying to figure out what direction to go.
Well, you came out of the closet pretty good, to speak.
Yeah, well, for your listeners, I've been trading the S&P futures contract since the day it came out in '82, and I've been trading the Value Line Index, which came out a couple of months before that. I am a very experienced, and I trade hundreds of these things. I'm a very experienced S&P trader, and the reason I'm talking about market structure instead of my leading indicators, which are deadly to trade this thing, is because the market's changed. People really need to understand that the market's changed, and there's a way to make a lot of money from this. But it's not from a traditional moving average. I mean, if you think you're going to make money trading a 200-day moving average, God help you, it's just not going to happen.
Okay, makes good sense. That's for sure.
Can I get back to this market structure issue?
Yeah, we're here. Go ahead.
Let's talk about plumbing. If you got a 3/4-inch feed line coming into your house, you're going to have a nice water supply and you can take a shower. If it's an 1/8 inch, it's not going to work. If you've got 2x4 floor joists, you're going to be able to walk on your floor without let's do that again. 2x10 floor joists, you're going to be able to walk on your floor without bouncing. If they're 2x4s, it's not going to work very well. The situation with the market now is that the lower time frames have been hoarded out by these computer and algorithmic trading, and it's causing this tremendous excess volatility. There are some estimates that in certain stocks, 90% of the volume is computer generated. Market structure is unstable today, and that's why you've got a situation. It's not COVID, okay? COVID is just an incident that happened, and it's awful and all that. But I don't mean to downplay it, but that's not why we dropped 40% in a matter of a couple of weeks. What happened was that we have a weak market structure. We've got 2x4s for floor joists, and the market can no longer handle a situation like COVID. And that's why you're getting the kind of volatility. You have got basically a situation here where there are literally predatory algorithms that are set loose in the market intraday, which move these markets around and which can crack a market. I mean, imagine for a second that you're a large trader, and I'm talking serious thousands of contracts, S&P contracts. The market's going up, market's against you. We're clearly moving up. He's short. Okay, so what's he going to do? He cannot buy at the market. It is impossible. It's going to go to infinity. He's going to get killed. So what he does is flip a switch. He sets a predatory algorithm off, and what this predatory algorithm does is it seeks a sell signal. Now, the sell signal it will typically seek is what I call an MACD predictor. I don't know if that's in any of my charts, but basically it is a predictive leading indicator that I've developed, which is a derivative of the MACD. And what this algo does is it searches to create a sell signal. When this thing creates a sell signal, sell, 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 and you're going to see the market crash through it. And the minute the market crashes through it, the algo sense that we've penetrated this, and what they do is they sell, and they sell in size. And that gives the opportunity for the trader who was short to absorb those sells and now get flat or get long the market. This is going on all the time. People don't realize it. The market goes down there. It has a thrust bar down at a 0.382 retracement back up. There is selling, allowing the large trader that's short to get flat or get even, goes across a little bit, and then there's an MACD predictor buy signal on a 5-minute chart. The market goes back up right to where it was before, and the public has been literally screwed, and some of these algos have been screwed along the way. This is the way the markets are working these days. Yuri from Russia has taken over our financial system, and I don't think that it's a good idea. And that's why when I'm given a microphone, and thank you so much, Larry, for giving me this microphone, I want to talk about what's really going on in the markets, because a lot of people just don't realize it. You listen to CNBC, they talk about, oh, the market's so terrific. It was able to absorb the selling from COVID. Yeah, it absorbed the selling from COVID 40% down in 3 weeks. This isn't absorbing. Just because there was a trade, 40% down doesn't mean the market's working. The market is broken. Market is broken. Now, we can take advantage of the fact that the market's broken, but the vast majority of people that aren't using leading indicators like Fibonacci, they don't know what they can't interact with this market. The volatility is just way too high.
Coast Investment Software, you want to continue, my friend?
Yeah, let's look at the third chart. That has to do with the market structure that existed, for hundreds of years, where you have a down move, you have a basing pattern, you have a test of the lows, and then the market moves up. This is what we have been used to in the past. Today, go to the fourth chart. What you've got is a very unstable and high-risk V bottom. Now, V bottoms have occurred all through history, but they have not occurred, every couple of weeks. I mean, we've got a market structure now which is almost untradeable for most traders, and those are these sharp V bottoms. The next chart that you can see, if I can get it up here, is the weekly S&P chart around December of 2019, showing a V bottom. And these V bottoms are extremely powerful patterns. I talk about how to trade them in Chapter 6 of Trading with DiNapoli levels, but that's really not the point. The point is that these things are occurring all the time. And the reason that they're occurring all the time is because of the low time frame lack of liquidity. What we've got on chart number 6, if I can get it up, I'm looking at it too, this is a monthly chart of the S&P E-mini futures. And again, we dropped like 40% in a matter of a couple of weeks. And then we go into this V bottom situation. These are unstable, very difficult to trade markets. And without making this all, a horror show talking about how you cannot trade these markets, well, you can, but you have to trade them differently than you would have traded them in the year 2000 or the year 2005 or 1987. You just cannot trade these things the same way. You must have the ability to get leading indicators on your charts. And nobody teaches leading indicators. I mean, I know you do, Larry. I do. That's my whole thing is leading indicators. MACD predictor, oscillator predictor, DiNapoli levels. If you don't have this kind of tool, you're basically screwed because the markets are too fast. I use the best trading software on earth. It is quantity quote graphic, expensive, but very, very good. When I'm trading the NASDAQ futures contract, Larry, I'm looking at the depth of market, right? And I have on a 5-minute chart, I've just completed an expansion up to a COP. In other words, I know where I want to put my sell order in because we're heading up to a COP. I've got my mouse, right? And I have a wheel on my mouse. And I am spinning it as fast as my finger will go. And by the time I spin that thing up to where the COP is, where I want to be a seller, the market can hit there and move away before I can actually get an order placed. And I mean, I'm talking seconds, but that's just too fast. Markets have changed, and that is the main thing that I'm trying to point out, and it's not a good thing. Lee Cooperman, famous hedge fund manager, has talked about this, and Lee Cooperman has tried to make some changes. He wants the uptick rule reinstituted, and there are some other changes that we could make to stop these phony orders that the large traders put in and spoofed orders. There's a lot of changes that could be made to make this market far more stable, far more accommodating to the average trader, and not just good for guys like you and me. But these changes aren't happening. There's just too much money into letting these algos have their own way. But my prediction is that this market's going to have a dislocation one of these days. And this dislocation is going to be very serious, like several limit down days. And then finally, somebody's going to do something about the way these computers are interacting with markets.
That makes good sense, and I believe that 100%. There's going to be some really drastic changes made on what's been happening with some of these things. So, I agree with you. But I think after it's all over, we'll probably go back to something that has been working for 150 years. But I have to agree with you here, Joe. We've never seen anything like this. These markets move; they move 1% in a heartbeat without even having a heartbeat. That's for sure. And it's not just the indices. You're seeing it in gold, crude oil, and natural gas, and treasury bonds. I mean, a lot of these are just going absolutely ballistic. And we have a question from one of our listeners, Joe. What effect do you think the Federal Reserve is having on this? We hear a lot about the amount of money they're putting in. Do you look at that at all as far as a parameter?
Well, it's a fundamental event like COVID. You have these fundamental issues happening all the time. And, right now we got the stimulus thing that may or may not happen prior to the election. The election is going to be a major event. And if we have time, I can talk about that. But it's just the Federal Reserve, obviously, it's moving the market, but it is simply a fundamental event. It shows up in the indicators that we use, and it drives the markets to certain levels upon which we can act. So it's just another event that we have to interact with. The point is that instead of it taking 6 days for the market to reach an objective because of what the Federal Reserve does, it takes 6 minutes. And the average guy can't cope with this. Even if they've got a 401k, and they look at their 401k. I remember talking to a guy in Thailand. But for your listeners, I live in Asia. Not now, but I lived in Asia normally. And I remember talking to a guy over a cup of coffee, and it was right at the bottom of the market in 2018, in December, near Christmas time, and he was getting rid of everything. And I said, dude, we're in an XOP. We're at an expansion point, but this is where you're going to be buying, not selling. He said, I can't take it. That every time I open my statement, I cannot take it any longer. I have got to get out of this thing for my mental health. And I said, well, okay, you get out. And this is happening to tens of thousands of people because they can't handle the volatility. They don't know how to interact with it. And if we have a few minutes, I'd love to give your listeners just a minute.
Well, we've got 2 minutes here, and then we got 2 minutes after the next break. But you let the cat out of the bag when you said election, so you better tell us right now what you're thinking about in the election, because I already have 3 people pinging me to say, please say more about the election. So can you talk to us about what you're thinking about here in the election?
Yeah, try to leave me enough time, though, because people that are on a long-term time frame, they need to know how to buy stocks right and sell stocks right. And I'm going to try to give that little bit of information. With regard to elections, yeah, I can talk a little bit about elections, and I don't want to piss off half the country because, I think one or another person is the best person to vote for. So I just want to talk about the economy, and I just want to talk about markets.
Let's do that.
There's a lot of reasons to vote for president, lots of reasons besides the economy and markets, but my expertise is economy and markets. So there's the disclaimer. I love China. I work in China. Okay. China is a competitor like you cannot believe. If anybody out there has any doubt, we are in a knockdown, drag-out competitive situation with China. They are the smartest, most hardworking people, and if we don't get our you-know-what together, we're done for.
Okay, we're back, folks. We're talking with Joe DiNapoli and Coast Investment Software. Joe, I've already got more requests here for you to be on the show than me. They want me to retire, and you take over the show. Can you come on again next week?
I would love to.
Just pick a day, and we'll work it out. But go ahead and continue, and we'll have you on again. It's just got so much information we can't cover it in 45 minutes, so we'll have you on again. And hopefully as a regular.
On next week, it's all going to depend on where my positions are in the market. I trade every single day, and I'm 90% sure we can do something. But I just want to give that one possibility that sometimes it's impossible.
What time frame, Joe? One of the questions is, what time frame do you trade when you're trading intraday?
Well, I'll trade all time frames from 1 minute all the way up to hourly intraday. Basically, what that means is when you trade, you need a context time frame upon which you use your leading indicator, like Fibonacci or oscillator predictor or whatever. And so, I get my context, let's say, from a 30 or a 60-minute chart, and then I'll do my entries on 1, 3, or 5s. It depends on the day, it depends on the activity, depends on the volatility.
Okay.
So that's the answer to that question. Can we get back to China? Because China is the most obvious play with this election.
I'm ready for it. Go ahead.
All right. I have to impress on people, since I've been working over there 15 years, presenting over there for 15 years, what we're up against. And I'm not talking about China cheating or any of that. I'm just talking about a flat-out competitive situation with China. They have a more efficient system of government. They have a mixture of capitalism and top-down. I mean, these people they have their you-know-what together. And here we are in America. We're divided amongst ourselves. We're arguing amongst ourselves. It's all about political stagnation and impeachments and all this stuff. And we do not have our eye on the ball.
Well, listen, we're going to have you on next week. Just keep in touch with me. Tell me when you want to be on. And thanks for being with us, buddy. We got to do this more than once every 15 years for sure.
I love you. I love you, Larry.
Keep the faith, brother. Tell Peppermint Patty I said hi.